Hello, this is Lance with Verivest, and today I have with me Fuquan Bilal. How are you doing today?
Fantastic, man. Fantastic.
All right. Well, thanks for joining me. So, why don't you share with us a little bit about how you actually got into the whole real estate investing game, and what's the origin story? How did you get where you are today?
Well, I've always been into sales. The short of it is my older brother was in the mortgage business and trying to convince me to become a loan officer. And I was like, I don't want to wait 30 days to make money. I want a weekly paycheck, you know?
Right.
So I was working for a computer company. I was a director of sales and, I made really good money. It was salary plus commission. And my cousin, who we've always been competitive, he started doing real estate and he actually made half my salary 3 months into the business. And I started to shadow him around, like, I want to go on that side, the flip side, the fixing and flipping. And that was back in 99.
Mm,
So lo and behold, it took me about 6 months, double the time it took him to learn the business. Plus, my older brother was teaching me about, mortgages. So I kind of learned how to do fix and flips and how to make sure the person who was purchasing it qualifies. So I got both ends of the business and made my first deal, which actually I made about almost $50,000. At the time, I was like 24 years old, making $85,000 a year. I thought I was on top of the world. And when I saw the opportunity in real estate that I had my freedom to do what I want to do, when I wanted to do it, I put my 2 week notice in and never looked back since November 99.
oh, nice. It's great. So, like for you, since that time, what is sort of your, how do you generate these opportunities? Like, how do you source your deal flow? Like, what's the acquisition strategy?
So real estate is a people business and your network is your net worth. So, really, again, creating long-term relationships with people, adding value to other people is really how I generate a lot of leads. For me, I connect. I'm a boots on the ground type of guy. I'm not a guy in the office with a suit and do a lot of stuff from, the office. I've always been boots on the ground, making those connections, going to meetups, going around the country, making the connections, attending masterminds, trying to figure out how do I generate deals. One of the ways I've been successful is direct to seller. We have our own in-house team that does campaigns direct to seller to generate leads. We're tapped into people who have programs where there's elderly people transitioning into senior living facilities that want to sell their house. We generate a lot of single family opportunities for flips that way in certain areas, in urban areas. Also, MLS is a way it's very competitive, but is a search that we do to generate leads from MLS, usually stuff that's been expired, certain key points that we look for to kind of do direct to seller campaigns on that. Nowadays, mostly is direct to seller because the affordable markets are insane. People are paying 20% over list price. So trying to compete with someone who's going to go to an open MLS to buy something is nonsense. We attend a lot of auctions, whether it be tax auctions or township vacant property auctions. It's just a variety of different ways. Just using all the tools that I've learned over the last 20 years to generate leads and keep consistent deal flow.
Got it. So, for you then, what are the markets that what are the key markets that you operate in that you look for deals? I think you're based in New Jersey.
Yeah, based in New Jersey all my life. I did live in California for a couple of years back in '96. But I've been in New Jersey doing real estate for the last 20 years. So we're northeastern type. Basically, my real estate is in New Jersey. We have another part of the business where we buy debt from the banks, which is mortgage notes. That's nationwide because the bank sell the debt in pools.
Mm.
So wherever the bank footprint is at, that's where our portfolio will end up at. And whatever is not in our buy box, when we take it down, we'll just sell it off to try to recapitalize on our spend a certain percentage and work the rest out through our servicers. But as far as real estate, we operate in 5 counties in New Jersey. These are 5 counties that I've been investing in for the last 20 years. Pretty much know all the inspectors, people in the towns. I've seen them grow from certain departments to, mayor and certain things like that. So again, I come from North New Jersey, which is really, a rough area. So for me to go back into these communities and revitalize them, kind of giving my feeling of importance. And that was why I was excited when I first got into real estate, because I was able to go and change the landscape, take these dilapidated properties, fix them up, and make better rental apartments for people in the community that I grew up with. So,
Yeah. So, like, maybe because So with those counties, and I'm not super familiar with the New Jersey market, but maybe share a little bit more color about that. I mean, I know that with like the COVID-19 stuff, I've heard a lot of people are leaving sort of the New York City boroughs, and I'm assuming that they're headed, maybe to New Jersey. I mean, do you see those sorts of things like
I think that's why our market is on fire right now. Everybody's exiting New York City and coming to New Jersey. The areas that we are in are B plus areas. Most of our 85% of our portfolio is subsidized rent. We do have a program with New York City Battered Women and Children where we help them get people out of the shelter into our apartments. They pay 1 year worth of rent up front for a full year, which is a great incentive. We make sure they qualify at least 2.5 times the rent. So they got 1 year to get, on their feet, basically, to kind of build the war chest while they're renting, to be able to stand on their own 2 feet after a year. So we're tied in with Section 8, where a lot of people before COVID frowned on Section 8. Now everybody's saying Section 8 is the greatest thing. We need a Section 8 rental. Because it's guaranteed rent. So we've always been there. Again, where I come from, those are the type of people that are in those communities that we rent to. So we've had a strong collection, somewhere close to 92% collection. During COVID, we fell down to maybe high 80s, somewhere around there, not too far. A majority of it was our cash paying tenants, of course. But that's really the driving factor in our portfolio is the cash flow from the rentals right now. In these areas, this B plus class areas in these counties, some of the counties in Essex County where I'm at, it's high end properties that we actually trying to pivot it a little bit. A year ago, we were buying properties that we were selling for $1,700,000. We saw, the market slow down with that. It's back up now, but we saw the market slowing down, so we pivoted to the affordable home market, buying stuff with more than ARV or FMV of around 350. That stuff sells fast and is selling faster now. But that's pretty much the markets we're in. Our real estate consists of flips and rentals.
Got it. Yeah. So it just depends upon if you find something you think you can kind of put some money into and put it back in the market, or it's like, it just depends. I mean, I guess it's a good kind of pivot. The next question is just about sort of your overarching, investment philosophy. And, when you got a deal in front of you, how do you determine whether it's a deal you want to do or not?
Well, we have a hybrid model. So I actually trademarked diversified hybrid real estate investing. My first fund that I opened up in 2013 was all notes. So the first couple of funds was just mortgage notes, and I did real estate in my private portfolio. So I wanted to really mix the two because I know that the rental income and the income for performing notes would be a buffer or a hedge against any market uncertainty. So the most recent fund that we have, the Diversified Opportunity Fund, has real estate and notes, and it also allows me to buy tax liens. So my philosophy basically is to create a vehicle that would have different types of asset classes that would create a buffer hedge against what's to come. And we had a lot of success with that in Q1 and Q2 because we really got the opportunity. We launched the fund in December, day after Christmas, December 26th, and we got the opportunity. We got right in the midst of it, during COVID. And like I mentioned, the rental portfolio, which was carried it because of the guaranteed rents that we had from the subsidized rent. So the philosophy is really having a mixture of different types of assets. I've seen, other, people struggle by just having one type of asset in their fund. And when that slows up or the opportunity or people leave, those opportunities to go into single family homes, it kind of drive the income down and they get in trouble. So for me, having a mixture of assets in one fund is, it's great. There's a lot of great tax benefits in it as well. Diversified hybrid real estate investing. That's my philosophy.
TM. Yeah.
Yeah, exactly.
Cool. So once you acquire an asset, I mean, what are sort of the main tactics or strategies you use to, ensure that you boost value or maybe ways that you kind of mitigate the risks that are inherent in investing?
Yeah. So on the note side, when we make a large acquisition, again, we just carve out where we have the largest footprint as far as legal. We outsource a lot of stuff. So wherever most of our vendors have a larger footprint, wherever we have the most attorneys at, we carve that stuff out. We give that stuff to our asset managers and our service to the work. The rest we'll sell to recapitalize a certain percentage of our spend. And then we just work that portfolio from there. Right now, on the note side, of course, because there's a moratorium on foreclosure and they just extended it. So now we're using different tactics and strategies to do collections, through the services and asset managers. As far as on the real estate side, again, we transition into buying stuff without major rehab, stuff that would cause a yield drag. My average rehab a year ago was 80,000. Now we're down to like 15,000. Stuff we can just get in, turn around, put in the market right away, and take advantage of this hot market that we're in. Same thing with rentals. If we're going to make an acquisition on a rental, we want to buy something that already have cash flow, something that we can just go and make improvements and increase rents as we go along. But we're not buying anything to rehab to rent because that creates a yield drag. So, that's really how we determine, what we're buying and what we're going to pay for it, and if it's a great fit, for the fund.
Right. So like now when you're making investments like the 15 grand sort of rehab reno budget, what kind of stuff are you typically, what are the typical things that you're having to do to a property to kind of get it?
Yeah, just paint. So we'll see something may have old siding. We'll just spray the exterior siding, do some nice landscaping, update any of the old windows that might have lit, painting it, change the front door, pull out the carpet, sand the floor, stain it, new appliances, stuff like that. We're looking to do, and just put it right back on the market. Whereas before we would go in and gut the whole thing out, new HVAC, new siding, just making it a brand new product, because the millennials that's out here buying, they want stuff that has, air conditioning and nice. They don't want the steam radiators and all the old stuff.
Sure. Yeah. Yeah. You go pretty deep, but you got a lot of bang for your buck. You're saying before, it's just that the market moves on you and you got to kind of adapt.
Well, we don't want to create yield drag. Before, those projects took a little too long. $80,000 rehab takes longer than a $15,000, $20,000 rehab. You can get in and get out in 3 weeks, and get the property on the market ready, so those larger rehabs take time because you have different vendors that go in, the framer, the plumber, electrician, and you got to go off their schedules, a lot to manage. So especially when you're doing it, I did 19 rehabs in 10 months. And that ended for me, that's really nothing. I know guys who do, 300 of these things a year or more, but that for me, that was a lot, 19 rehabs in 10 months. And it was a lot because those were very large rehabs. And what I learned through that whole process is the ones, of course, that were $25,000 and less, when I started to measure my KPIs, how long it took, what was my return, those are the ones that had more profits than the ones that it took longer,
Right.
So.
Right. Yeah. So that's when you refer to yield drag, it's almost like it's the forcing function of operating, because most of your vehicles are open-ended vehicles. So do you feel like that's heightened your kind of awareness then for the ROI in your dollar? Whereas even if you did them one-off, you might not ever fully appreciate the impact it has. Is that kind of what you
Absolutely.
Yeah,
absolutely. Because it's taken longer. So it's costing me more interest before I get, I exit it. So
yeah. So you learn, what do you need to do to still generate that, similar or better return on investment for an individual project.
Absolutely. And we saw finding projects with low cost to renovation help speed up, create more velocity, which in turn create more profit.
Yeah, that's great. So, outside of yourself, so who else who are the key players in the team, or maybe other vendors that you use that kind of make the magic, so to speak?
Yeah. Years ago, I used to have a big shop, man. I had 15 people staff and an office full of file cabinets and everything. And I learned that, the only way you can really scale is to outsource. Mm-hmm. So we outsource a lot of our stuff. Probably 60% of what I do is outsource to document custodian, loan servicers. We have a few asset managers in-house. We also outsource to some asset managers that kind of manage the loan servicer and foreclosure process and the note side. Mm-hmm. And then we have an in-house property management team that manages the rental portfolio. I haven't been able to find a great property management company outside yet. So right. We keep all that inside. I think we're definitely going to do that because we get really to monitor the expenses and the costs, which most property management companies, tend to increase and just mess up the numbers from other people that I know that have property managers and cry about it and everything else. So
sure. Yeah, well, there's not as much alignment, right? So like for them, they make markup on the vendors they send out, or Yeah, I mean,
Absolutely. So we control all that in house. So that's what most of my staff and my team consist of. Property management staff. We have a couple of in-house people that go out and do small minor repairs. They're on payroll. Really managing the data is really, really important. So I have people on my team that pull data from the loan servicer, the document custodian, the asset managers, and we just look at the KPIs and kind of figure out on a weekly basis, what can we do to make it better? How can we cut costs over here? How can we speed up the service call over here? So, these are things that we stay in sync with every week, and we see when we make improvements, the numbers increase, the costs get cut. So really grateful for my team and what they do, but most of them are vendors that we just leverage human capital.
Yeah, most definitely. I mean, it makes a lot of sense. Yeah, that's great. Well, cool. Well, thanks so much, Fuquan. That's great. Learn a little bit more about yourself and your team, and you have a great day.
Thank you. I appreciate it. You have a great day as well, Lance.
All right. Thanks, man. Take care.
All right.